Welcome to Interest Rates 101 with your hosts Mike and Steve. In this video, we're going to give you guys a brief introduction to interest rates and share you guys some of the most commonly used interest rates. So Steve, what's an interest rate?
I'm glad you asked, Mike. Simply put, interest rates is the cost of borrowing money. They're used in almost every financial equation and almost every asset pricing model out there. Mike, tell me a bit more why interest rates are important.
Steve, that's a great question. Interest rates are such an integral part in every economy. When interest rates are low, it makes the cost of borrowing money cheaper. So people tend to go out into the market and buy more goods, which will typically expand an economy. And like Steve said, they're linked to every financial instrument that we have in the market. Stocks, bonds, derivatives. For example,
when interest rates go up, the price of bonds fall and vice versa. And remember, interest rates are always quoted annually, unless otherwise stated.
So now that we know what an interest rate is, let's take a look at some of the most commonly used interest rates.
Let's take a look.
Alright guys, so the first interest rate we're going to cover is the Fed funds rate. So Steve, what's the Fed funds rate?
Mike, the Fed funds rate is the rate that banks lend each other for short periods of time. Now this is just typically overnight. Mike, why are banks lending each other money for such short terms?
Steve, that's a great question, and I have a great answer. It's because of reserve requirements. So what are reserve requirements, you ask? So I answer. When you deposit a check in a bank, the bank lends out most of that money in order to generate interest on it. Now, a portion of that check they have to keep in the vault. That's the reserve requirement. When banks are short of this reserve requirement, they typically borrow money from other banks for short periods of time, like Steve was talking about, in order to meet this requirement. The second interest rate we're going to cover is the risk-free rate, commonly used in academia all over the world.
Now, Mike, doesn't everything in finance have risk?
Well, yeah, except for the risk-free rate.
And where in the world does that come from?
The risk-free rate is backed by the government. Now, stay with us. Since the government hasn't defaulted, and we don't think it will default, and our government can print its own currency, it essentially creates a risk-free investment for the investor. Now, this rate is typically low because if you remember in finance, high risk, high reward. Since we have minimal to zero risk, our return is going to be very low. So that's the risk-free rate. Let's move on to LIBOR.
So Mike, let's talk about LIBOR, or the London Interbank Offered Rate. This is the benchmark for short-term lending on the international stage. It is in essence the real-world version of the risk-free rate.
Now Steve, isn't it based on 5 currencies?
Yes it is. It's based on the euro, the US dollar, the Japanese yen, the British pound, and the Swiss franc all play a role in it.
The next 2 interest rates we're going to cover are very closely related to each other. They're the real interest rate and the nominal interest rate. So Steve, what are these?
Well, Mike, when I was a student, people got this confused all the time, and I have an easy way you're not going to forget it. The nominal rate includes inflation. Nom, it eats the inflation rate. Now, the real rate is your nominal rate minus inflation. So again, real does not include inflation. It's really the buying power that you gain. So nom, inflation. Real, no inflation. Now, Mike, tell me you can't remember that.
Oh, I'll remember it for sure. Alright guys, so those are some of the most common interest rates we see in our everyday lives. So now let's briefly talk about compounding. By now, we all know that interest rates are quoted annually, but they may not always be compounded annually. Let's take a look at some of the most frequent compounding methods. First we have
annual,
which is compounded once.
Semi-annual,
which is twice.
Quarterly,
which is 4 times.
Monthly,
12 times.
Daily, and continuously. So what this means is you have your annual quoted rate. You need to divide that by the number of compounding periods that we just discussed. That rate is then applied that many times throughout the year. For example, 6% semi-annually would be 3% and then another 3% on that. So by the end, you have a rate slightly over 6%. That's why compounding is also called interest on interest.
Alright guys, so that was a good introduction to interest rates. Now interest rates are very complex, there's so many out there, a lot of which we didn't get to cover. If you'd like to learn more about interest rates and you don't want to get confused with the 7 definitions the internet gives you and they use a bunch of words that you really can't understand, just send us an email. We'll be happy to go over anything we talked about or anything you guys want to talk about. So far we've responded to every email we've gotten and we can't wait to read yours.
Guys, thank you for the support and we hope you learned a bit from our video.
Rate. Steve, what's the Fed funds rate?
Well, Mike, the Fed's funds rate. College students.
All the way up to our most seasoned viewers to be able to understand our videos.
I heard. So, Mike, why are banks lending each other money just overnight?
All right, guys. So the first interest rate we're going to cover is the Fed funds rate. Steve, what is the Fed funds rate? It's something that makes Steve laugh a lot. That's why he can't say his line right now. That's the problem. Now, Steve, since by now... Welcome. Welcome to Interest Rates 101 with your host. Steve and I would both like to thank you guys for watching our first... Why are you looking over there? The most commonly used interest rates.
Try not to laugh so hard.
You laughed. Much every financial I can't say that word. Instrument.
That was it.
Welcome to Interest Rates 101 with your hosts, Mike and Steve.
Shut your salute.
Welcome to Interest Rates 101 with your host. No.
With your house.
So, Steve, what's an interest rate?
I don't know.
I don't know either. Use interest rates. Steve, what is an interest rate? Funds rate.
Well, Mike, the Fed funds rate is the rate that banks lend each other money short term, and it's typically just overnight. So, Mike, tell me why you are laughing.
You're so into it.
I
love it. Hey, guys. So the...
Want to know what is it worth to me in today's dollars right now. So, present value, the formula. All right. So now that we understand future value, we're going to...
You got to erase the formula. Funds rate. Steve, what's the Fed funds rate? Steve, not sure of what the Fed funds rate is. It's why he's walking away right now. He's not sure what it is.
And have a safe and happy 4th of July.
Put my hand up right at the end.
You did. You did.
That's a blooper.
That's